Ever scrolled through social media and seen people talking about buying the dip or investing in Tesla? Ever wondered what exactly they're buying? Today we're breaking stocks down with speed and clarity. A stock is ownership in a company. When you buy a stock, you literally own a tiny piece of that business. Picture your favorite company as a giant chocolate cake cut into thousands or even millions of slices. Each slice is a share. If a company had only 10 shares and you owned 5, you'd own half the company. In the real world, there are usually millions of shares, so your piece is smaller, but the idea is the same. Why would a company sell pieces of itself? To raise money, growing a business isn't cheap. Instead of borrowing from a bank and paying interest, companies can sell shares and keep the cash to build new factories, launch new products, expand to new countries, or simply pay the bills. To make this real, meet Maya. She wants to launch Fresh Kicks, a limited edition sneaker shop. She needs $100,000 but only has $50,000. She divides the business into 10 equal shares. Because she's putting in $50,000, she keeps 5 shares. Each share is worth $10,000. She sells the other 5 to investors who believe in her. Jordan, a sneakerhead, buys 1 share for $10,000. That makes him a 10% owner of Fresh Kicks. With 5 investors each buying 1 share, Maya raises the full $100,000 and opens her dream store. Fast forward 5 years. Fresh Kicks is on fire with multiple locations, and the business is now valued at $300,000. Jordan's 10% is worth $30,000. If he sells, that's a $20,000 profit. But it can go the other way. If Fresh Kicks struggles and the business value falls to $80,000, Jordan's share is worth $8,000, a $2,000 loss. That's stocks in a nutshell. Ownership that can grow or shrink based on the company's performance. Some companies also pay dividends, which is like getting a slice of the profits just for being an owner. Where do you actually buy these slices? On a stock exchange, which is a marketplace for shares. The New York Stock Exchange and NASDAQ are the big names. These days, you don't have to show up in person. You can use investing apps on your phone to buy and sell. When a company gets big enough, imagine Fresh Kicks going national. It might go public by listing on a stock exchange so anyone can trade its shares easily. Here is where it gets interesting. Not all stocks are the same. There are 2 main flavors: common stock and preferred stock. Think of them like regular tickets and VIP tickets to the same concert. Common stock usually comes with voting rights. 1 share equals 1 vote on big company decisions and board elections. Dividends for common stock can happen, but they're not guaranteed. The upside is growth potential. If the company crushes it, common shares can skyrocket. The downside is risk. In a bankruptcy, common shareholders are last in line and can end up with nothing. Preferred stock is more like the responsible older sibling. Preferred shareholders usually don't vote, but they get a big perk: priority, often fixed dividends that get paid before common stock. If the company ever goes bankrupt, preferred shareholders stand ahead of common shareholders in the line to get paid, though still behind creditors. Preferred is kind of a middle ground between stocks and bonds. Less risky than common, but with less growth potential. Quick pause for you. Which would you pick if you had to choose today? Common stock for growth and voting, or preferred stock for more reliable dividends? Drop your answer and your reasoning in the comments, because your logic helps everyone learn. Now, why do people invest in stocks instead of just keeping cash in a bank account? Potential growth. A bank might pay around 1% to 2% interest per year, but over the long term, stocks have historically returned about 7% to 10% per year on average. That's the reward side. The risk side is volatility. The stock market can feel like a roller coaster, especially in the short term. Some people buy and hold for years, hoping the companies grow. Others try to trade more frequently based on price moves. No matter your style, one simple rule from the pros still stands: don't put all your money in one stock. Diversify and start with companies you actually understand and believe in. If this made the stock market finally click for you, hit subscribe to Squirrelonomics for more fast, clear breakdowns of money and markets. Remember, when you buy a stock, you're not just grabbing a random number that wiggles on your screen. You are buying ownership in a real business. The big question is this: what slice of the future do you actually want to own?